The U.S. housing market is in a worrisome state. People are buying homes they can't really afford, similar to what happened in the 2008 financial crisis. Recent data from Fannie Mae shows that many homebuyers owe more money compared to what they earn. This situation might lead to more people being unable to pay their mortgages and losing their homes. Let's explore this issue further. If you find this information helpful, please like and subscribe to the channel. Many people don't think a big housing crash will happen soon. They believe the housing market is stable because of good mortgages and loans. But this idea is not accurate. If the economy gets worse, we might see a lot of people not being able to pay their mortgages. This is a big problem, especially for low-income homeowners. The situation now is even riskier than in the past. Recently, Jerome Powell, who works with the U.S. government, talked in Jackson Hole, Wyoming. He said that the current mortgage rates, which are at 7.4%, will stay high for a while and might even go up more. Powell also mentioned that the Federal Reserve, which manages money in the country, will use special policies to keep prices from going up too much. In future meetings, the Federal Reserve will decide whether to raise rates even more or keep them the same. This matters a lot to people buying homes and making investments, so it's important to think about these things when you decide to buy a home or invest your money. Looking back, we see that in the previous housing boom, home values dropped a lot, about 35%. Right now, home prices seem too high, about 23% more than they should be. There's a concerning trend where people are buying homes they can't really afford. Information from Fannie Mae, a financial source, shows that home buyers have more debt compared to what they earn, and the interest they pay is really high. This problem gets worse because home prices all across America are really high, like a never-before-seen bubble. On top of that, the cost of mortgages is going up, reaching almost 7.5%. If someone wants to buy a home today, they'd need to pay around $800 each month. This is a big financial load, and many people might not manage to pay their mortgages. This could lead to lots of people losing their homes, which would not only hurt them, but also damage the entire housing market. We need to take action now to stop this problem from getting worse. The Federal Reserve, which controls the country's money, says they're going to raise interest rates. They're doing this to make less money available in the financial system, and they call it quantitative tightening. The timing is crucial because the government has borrowed a huge amount of money, about $1.5 trillion in just the last 2 to 3 months. To get this money, the government is selling something called Treasury bills, and their prices have gone really high. But the Federal Reserve isn't buying these bills anymore, so the demand is going down and interest rates are going up. This move could have big effects on the economy in the short and long term and how businesses work. So, what the Federal Reserve decides is very important and needs our close attention. Let's take a closer look at the state of housing inventory and its impact on home prices. Data from the National Association of Realtors reveals some interesting patterns. Just before the economic downturn, the number of homes available for sale increased from 2 million to 3 million, which represents a significant rise of 1 million units, or a 50% increase. This sudden surge in supply had serious consequences for home prices nationwide. We saw a national decline of roughly 25%, and in some areas like California, the drop was even more dramatic, reaching up to 40%. In Nevada, the situation was astonishingly severe, with home prices plummeting by a whopping 60%. While housing inventory has made a partial recovery since those dark days, we're still operating close to historic lows, with only about 1.1 million homes currently available for sale. It's worth noting that even a modest increase in inventory, say around 500,000 to 600,000 homes, could potentially trigger a significant 50% increase in supply. However, we must carefully consider this possibility in light of the challenging affordability conditions for prospective buyers that still persist today. To better understand the financial dynamics of home buyers, it's crucial to explore debt-to-income ratios and their significance. In the United States' recent real estate history, home buyers who made investments in the years 2020 and 2021 were generally considered financially stable, even though they had access to relatively low mortgage rates of around 3%. However, it's important to recognize that these buyers had to manage their finances within specific debt-to-income ratios, typically falling in the range of 35 to 36%. But what exactly is a debt-to-income ratio? And why is it so important for home buyers to grasp? This ratio is essentially the total of your monthly debt payments divided by your gross monthly income. It's a key metric that lenders use to gauge whether you can comfortably handle the monthly payments required to repay the money you intend to borrow. The connection between a home buyer's debt-to-income ratio and their risk of being house poor is a vital factor when assessing the potential for default or foreclosure This is particularly relevant in the current U.S. housing market landscape, where many homebuyers are opting to put down very little money on their property purchases. This trend has led to historically low average down payments, with an inverse closing LTV, loan-to-value ratio ranging between only 16 to 17%, which is actually lower than what we saw during the peak of the largest housing bubble in 2004 to 2006. The implications of this trend are significant and evident in the increasing levels of debt and interest costs that homeowners are facing. As more buyers opt for minimal down payments, their equity in their homes decreases, making them more vulnerable to fluctuations in the market. Let's consider the current state of loans and how it affects the real estate sector. The good news is that current loans seem to be slightly better than those in the past. The reason for this is that today's loans are subject to a more thorough examination of an individual's income. Additionally, most loans come with fixed interest rates, reducing the risk of facing unpredictable adjustable rates. As a result, the likelihood of experiencing a massive wave of 10 million foreclosures seems low. However, there's still cause for concern as the potential for 3 to 4 million foreclosures remains a very real possibility. Such a scenario could have devastating consequences for the real estate sector, causing severe damage to housing prices. It's essential to note that the current housing inventory levels in California are quite low, leaving very little room for market errors. Compounding the situation, the sustained higher interest rates pose a significant challenge, particularly in the case of mortgage rates, which have surged to 7.7%. This has led to a sharp decline in mortgage applications for property purchases, a trend not seen since 1995. These circumstances create an environment where we must remain vigilant and prepared for potential economic challenges. As we move into the latter half of 2023, there's a growing likelihood that property prices will continue to decline. This scenario presents a challenging environment for home sellers in California, prompting the need for a reevaluation of their property price expectations. However, it's essential to understand that this extended period of slow sales activity could have far-reaching effects on the broader economy. For example, realtors in the United States are currently grappling with significant challenges. On average, they're managing just 2.3 home sales each year. The pressure on realtors to generate sales is intensifying, and many are contemplating leaving the industry altogether. Notably, there has been a visible decline of around 1% in the number of realtors each year. This trend is expected to extend to other sectors of the real estate industry, including mortgage brokers, home flippers, and real estate investors who are likely to exit the market in the near future. This pattern of withdrawal reflects the ongoing economic environment, which is anticipated to feature an extended period of high interest rates. Furthermore, this phenomenon is projected to lead to a noticeable increase in business closures and workforce reductions, particularly in the latter part of 2023. Therefore, it's crucial to stay vigilant and consider the possibility that the current situation may persist for some time, bringing with it negative consequences that we must be prepared to address. Recent data highlights that commercial banks operating under the Federal Reserve's jurisdiction have made limited progress in expanding their lending services over the past 6 months. While some may view this situation as a positive development, with banks exercising more caution and discretion in their lending practices, it's important to recognize that this lending stagnation carries severe implications for the broader economy. Lending plays a vital role in driving economic growth and development. Due to the cautious lending practices of banks, an increasing number of individuals seeking consumer loans are being denied this essential financial assistance. The consequences of this economic strain can manifest in various ways, including a rise in the rejection of business loans and the inability of people to refinance their mortgages. Unfortunately, these outcomes have the potential to cause financial hardship for many. In conclusion, the economic landscape is evolving, and the challenges we face are significant. Property prices may continue to decline, and the real estate industry is experiencing substantial turbulence. Realtors and other real estate professionals are grappling with mounting pressures, and this trend is expected to persist as interest rates remain high. Businesses may face closures, and many individuals could encounter difficulties securing essential loans. In response, it is crucial for all stakeholders, including policymakers, financial institutions, and individuals, to collaborate and seek sustainable solutions. This situation requires our collective attention and action to mitigate its negative impacts and pave the way for a more stable and prosperous economic future. Thank you for being part of this vital conversation. We appreciate your time and interest in this critical matter. Your support through likes, subscriptions, and comments is invaluable to us. We encourage you to stay engaged with the latest updates and information on this subject by watching additional videos in our channel.